Okay, finally, before deep diving in how to manage and build financial reports on SAP ERP, it is essential to clarify some main rules which are related to financial accounting. And one will refer to how the financial reports are essentially built, while the other ones refer to how assets are evaluated in financial documents. Let's focus first on what you already seen as depreciation, so asset depreciation, which is concerned with the decrease in the value of an asset over time. First of all, let's see that depreciation can be performed using two different and complementary approaches: straight line approach and double checking balance approach. Let's see the difference between the two. The straight line with the straight line approach, just make the hypothesis that an asset value is acquired today by a company at a cost of $5,000 with a life cycle of 5 years. This means that the allocated cost on the income statement each year will be $1,000, and this will continue until the end of the life cycle of the asset, when the final value of this asset will be essentially zero. So here we don't have the 5th year, but here the value will be 1,000 at the end of the year, and then 0 at the end with the final depreciation expense is incurred. As far as this is true, as far as the revaluation of the asset is not experienced during this life cycle, but we will see how to deal with that in a few seconds. Instead, with the double declining balance approach, the cost allocated is not a constant rate every year, while instead a constant percentage of the remaining value. So in this case, the asset value at time 0 is still $500 with a life cycle of 5 years. And the company decides that the constant rate is 40%. This means that during the first year, the depreciation will be 40% of 5,000, so 3,000. The initial value will be then, at the second year, will be that 3,000, and again, another 40% percentage is used in order to depreciate this asset, reaching the value of 1,800, and so on. On the final year, we will just reach 0 by subtracting the remaining value from the starting value of the asset. Of course, once an asset is unowned by a company, it needs to be retired or disposed at a certain time of its life cycle, or at the end of its life cycle. When an asset is dismissed, this can be made by generating revenue, of course, if an asset is sold as an higher value than its book value on the balance sheet, or at no cost, also by just disposing the asset as its value, or by generating cost, if an asset is sold at the value lower than its book value. How to manage this type of evaluation, reevaluation, and so on, by following essentially 3 basic evaluation principles. The first one is what we call using the historical cost, which means that an item is evaluated at the original monetary value paid for its purchase or its manufacturing, so if made internally. Or we can use the fair value, also known as market value, which says that an item is evaluated on the basis of the amount for which it could be exchanged between knowledgeable, willing parties in an arm's length transaction. So the price that the market is going to pay to buy this kind of asset, or using what we call the value in use, where an item is evaluated at the discounted present value of its estimated future cash flow expected to arise from its continuing use plus its disposal at the end of its useful life. Then we will see the formula, but it's essentially the calculation of the net present value of the asset functioning from now toward the end of its life cycle. Let's see some examples for each of these. Let's start with historical cost. How to evaluate an asset at historical cost? Let's make the hypothesis to purchase at today a plant at a price of $1,000 with an economic life of 5 years. With historical cost, each year the plant is evaluated in the balance sheet at the historical price less accumulated depreciation. It means that from 2010 to 2012, its value will be decreased by 200, which is exactly the ratio between its initial value and its life cycle, and so on during the years until the value of 0 is reached in 2015. With the fair value, instead, we need to use the market price in order to evaluate the asset. We have the same example, so we purchase the item today at the price of 1,000 with an economic value of 5 years, and each year the plant is evaluated in the balance sheet according to its fair value, so the market value of the items. Of course, for example, in this case, in 2011, we see that the market value of this asset has decreased to $850, which was different if compared to the previous example. Of course, how to determine the market value of this type of assets, this depends on the nature of the asset, because GAAP established that, for example, for building and land, evaluation is made through market parameters by an external expert examination. For machinery, the evaluation is made through market parameters, again made by an expert examiner, which is neutral to the company. While for intangible, first of all, these items need to have an active market to be evaluated, where you can find price which are available and can be compared, and should be representative of the customer base value, so the value that the customer is willing to pay to acquire these intangible assets. And again, this evaluation involve the suggestion and the input of an external neutral expert examinators. Finally, when we deal with the value in use, we include what we call the impairment test. The impairment test is that test which enable companies to identify if an asset has lost some of its value, as companies must periodically review almost all of its assets to look for an indication that if some loss of their value has been experienced. For example, for market value, if the market value declines, if there are negative changes in technology, if there is obsolescence, or if worse economic performance are experienced, and so on. And to do that, companies need to perform what we call an impairment test. With the impairment test, the book value of the asset is compared to what we call the value in use of this item, and the value in use of the item is evaluated at the discounted present flow value of estimated future cash flow expected to arise from the continuing use of these assets until the end of its life cycle. And that's the formula. I mean, you can see that the value in use of the assets is the sum of the future cash flows generated by the assets to which the discounted rate is applied, plus the terminal value, let's say, registered at the end of this life cycle. So this big T represents the time in which the assets will end his business life cycle. Of course, if the recoverable amount is higher than the expected carrying value at the end of the year, the item is not impaired. Okay, so if the value is higher, the item is not impaired. Why? If the item is impaired, it means that it has experienced a loss of its value and it is impaired at the islet between the fair value and the value in use. And if the a loss is experienced, this loss represents a cost in the income statement. Let's see also in this case an example. Let's reconsider the example before. We have an asset that after the first year has this market value, and after the third year, we know that the market value is 300, while the value in use is 450. This is a problem because my assets is evaluated on the market at 300, while instead its effective value is 450. This means that these assets will be impaired at the value of 450, and in particular the impairment loss will equal to the difference between 450 and 300, so a loss in the income statement of 150. Finally, let's finish by considering which is the basic accounting principle for designing and compute transaction in the financial documents, what is called the double entry rules. Double entry accounting, also called double entry bookkeeping, is the accounting system that requires that every business transaction or event needs to be recorded in at least two accounts, as we can see here. And this respects what we call the accounting equation. Every liability that is recorded must be matched with an asset item, and this means that at every asset increase corresponds a liabilities decrease, and vice versa, as you can see here. So, if a debit increase on assets, a credit decrease. If a debit decrease on liabilities, a credit increase, and if a debit will decrease on the equity side, the credit decrease. This assures you that in any moment of time, the total of assets will be matched with the total value of the liabilities plus equity. Let's make an example of this practice on how this practice is implemented in action. So suppose that you purchase a new desk that costs 1,500 for your office. This transaction actually is divided into two parts. You spend for the asset, so you have cash, and you buy another asset, so a new furniture. So you must adjust two accounts in your company book. On one side, you have the cash account, and on the other, the furniture account. And here is what the transaction look like in the book, in what we call the bookkeeping entry. You first record the accounts impacted by the transaction. So the debit increases the value of the furniture account, while the credit decreases the value of the cash account. For this transaction, both accounts impacted are asset accounts. So in this case, you both impact asset accounts. So looking at how the balance sheet is affected, you can see that the only changes are to the asset side of the balance sheet equation. So It means that the furniture increase and the cash decrease, and so the asset are then balanced, and the equation is respected. Let's make it another example. While instead we decide to purchasing the items on credit and so not on cash. So you purchase you decide to purchase the same items instead of by paying by cash on credit. This widget of purchase on credit will add value on our inventory asset account, but they also add something on our accounts payable account, where accounts payable is a liability account where you track bills that need to be paid at some point in the future. And here is how this action affects the double entry bookkeeping transaction. So as you purchase some widgets on credit, you first touch the inventory account, which will be increased by $5,000 on the asset side. However, as you purchase on credit, you need also to increase a liability item, in particular the accounts payable on the credit side of 5,000. In this case, the books stay in balance because both sides of the equation increased of 5,000. So both debits on the asset side and both liabilities on the credit side will increase of 5,000. So the equation stays valid, while instead in the previous example the equation stays valid because the two operation counterbalance with each other.